Alright, it's recording now.
All right, brilliant. So, what I'm going to do, like Lamar just said, I'm going to be doing a little an explanation on how I approach the markets in the morning. Um, so, what we're essentially doing, you know, how I teach, how I explain things, what I'm looking for is, we want to build a narrative, right? So, narrative basically is a story. So, the intention, if you can build up a story and a narrative, the confidence for your entries and it becomes so much higher, so you tend to find that your win rate is a lot higher because you're trying to follow what the market needs to do instead of trading what you want to see or what you want to happen. That's when you go down the slippery slope, because if you start saying, oh, I want it to do this just because you might make 5 or 10%, the majority of the time it's not going to do it, which is why some of the trades you might see me post, they could be a 1 to 10, and it could be a 1 to 3 risk to reward, but they're both the exact same, entry concept, because it's, different, I don't know, time of day or just different, it's different times. So they can vary on things like that, which is a good way because you're following, the facts. You're not just trying to catch these big unrealistic trades all the time. So with that, what I'm looking for in the mornings, if I jump down to maybe the 5 minute, let's have a look at the previous day. So here, this must have been Friday. Friday. Yeah. So here, as you can see in the markets, if we look, this is around, London Open, right? This whole zone here. So I'm coming onto the markets, and this is what I'm seeing, right? I'm seeing the up move towards this zone, but obviously I didn't have a zone here. So what I would be doing straight away is, the 1 hour, the 4 hour is as high as you really kind of need. If you're trading every single day, the 1 hour and the 4 hour, you don't really need to go above that. If you're only trading a couple of times a week, then maybe it is kind of necessary to jump up to the daily or the weekly just to get the bigger picture. But where you're following it daily, like the majority of us are, you don't really lose track of the market's intention, right? So maybe it was the 30 minute. I'm trying to find. Okay, so the 30 minute, if we have a little look here, as you can see, we've got this order block, we've got an IFC candle, we've got this huge impulsive move to the downside, leaving quite a large imbalance, right? So the first thing I would have done is I would have marked out this imbalance, right? This big zone. So here, there's no structure, there's no price in the high time frame inside here. So that is leaving a fair value gap or imbalance, whatever you want to call it, right? So after seeing that, I would have then flicked through the 15. Can I see anything? Not really. Jump down to the 5 minute. Why I'm doing this is because I'm trying to refine it. So here on the 5 minute, as you can see, we have a grey candle. This here is a completely valid order block for me. Usually I put it to, I'd have it something like that. When we get big wicks like this, I usually have it closer. I'm not going to go too much into it because it's a bit confusing, but that's what it was like for me. And as you can see, coming across, the whole point of building the intention is so we're not going to be entering off of the first tap, because the entering off of first taps also confuses people like mental, because you can have a first tap and then hit your stop loss and you're sat there questioning why it didn't go down, right? And it could have gone down, could not have gone down, maybe because there's an order block up here and so on and so on, and that's why you're waiting for reactions, waiting to see price retrace from a zone is the main thing. Because if you're just entering the first tap, there's no reason why it shouldn't continue up, right? So waiting for a reaction like this and then entering, just even if it's just a candle coming down a bit, that does just give us a bit more confidence that price is given some type of hesitation from the zone, right? So essentially what we're looking for is price to hit this zone, right? And then before we're letting it hit this zone, straight away we're thinking, right, what needs to happen before finding an entry, right? So first of all, we've got 2 3 rules, right? We need a shift and we need liquidity. So the first thing we need is to see shift. So we need to have some type of, especially because it's a reversal, right? We need to see some type of confirmation that price is rejecting that zone. So where is our shift, right? Our shift is going to be the previous higher low, sorry, which is going to be this zone and this zone. I think I just marked out this one, not this one as well. I'm going to leave it to this zone, because if we jump down to the 1 minute, where are we? as you can see, this low created the push to the upside, failed to break the high, so we come back down. And then we've seen price break the previous low, right? So back up to the 5 minute. So that there is my valid break, right? So after we've had the shift, what does price need to do? Price needs to seek some type of liquidity, because without liquidity, we're not going to move. We're not going to go anywhere, which is a massive thing when it comes to entries. And I see a lot of people, especially on TikTok and stuff like that, taking these trades before a liquidity sweep, wondering why they've hit their stop loss, because the majority of the people that, are trying to sell here still have their stop loss potentially at a valid zone, potentially above this high on the lower time frame or up here, and wondering why they've been stopped out, or they've come all the way up into their stop loss. It's a silly mistake, because even though you do have your stop loss up here, your risk to reward's only 1% or 2%. It's just, once you understand and master liquidity, your risk to reward doubles, triples easily, and it's the most simple tip you can follow, right? So on the high time frame, our first point of liquidity, I think I might have actually been looking on the 1 minute. I can't actually remember. If we go ahead and jump down to the 1 minute, as you can see, this is our first point of liquidity, right? There's no liquidity in this leg. So in this leg, there's no liquidity. So our first point of liquidity is this high. But then if you look, this high has mitigated this order block. And this order block had mitigated this order block. So there's no valid zone underneath this high that could turn price around, right? So that's then when we have that as our first point of liquidity, right? So that's our first point of liquidity. Jumping back up to the 5 minute, we're now going to look for a POI around, because we've built that intention now, we've built that narrative, we've had the shift. We need to have that liquidity sweep for price to continue, even if it's just to come down to this order block. If we need price to come down here, we need to grab liquidity. This is our first point of liquidity. This is our first point of interest above the liquidity. So it's a no-brainer. Obviously, there's no reason why you shouldn't mark out this supply zone as well. Because at the end of the day, not everything's off of probability. There's nothing actually gonna. Are you guys seeing the video? I can't see anything. I am screen recording on it, screen sharing, right?
Yeah, man, I can see it.
Okay, cool. Lessons, if you don't stress too much, if you can't see it, the video is being recorded, the call is being recorded as well. There's no reason why we shouldn't have this supply zone marked up, right? Because we've got the order block, we've got the displacement, we've got the shift, that is valid. However, you need to take into account the other POIs, just because it can turn around anywhere in here or in here, which is why you wait for the reactions, right? So now we've got our POI. Well, the first POI is this imbalance. The only thing I'm going to be looking for now is just to see a slight reaction from this zone, right? So our reaction here, as you see, price had a huge impulse up to this zone. If you're seeing this amount of strength continuing up, you would think that price, wouldn't have a big retracement like this. We would just want to see price continue up and should hopefully smash through that. But however, it didn't. We can see price has a big sell-off candle here. And then my thing with reactions is, if we have a nice pullback candle like this, almost leaving like an IFC or an order block, if price pulls anywhere back into that candle, anywhere inside here, I'd potentially take an opportunity, because we're quite confident on the direction, we're quite confident on the POI, we've got the liquidity, so there's nothing that I would physically be doubting. And that's the whole point with being confident when it comes to trading, because if you're confident, you're not going to second question yourself. You're not going to doubt yourself. You're not going to doubt the trade. You're just going to let it be. You can walk off knowing that you've got enough liquidity, you've got enough. You've got the shift, you've got a POI. So the only reason if it was to continue up is because you just missed out. You missed the high time frame, right? And you got the direction wrong. It's got nothing to do with the entry. So that is the entry. Targeting down to this demand, because my whole intention here was price was going to tap into this demand and then continue to the upside, right? So if price wants to go back up to the upside, we need to sweep liquidity. So we need to see price come down, right? So it's the whole point of this all. don't set a limit order, just wait for reactions. Yeah, just wait for reactions. That's the whole point with limit orders. I don't be entering on the first tap, right? So we want to be waiting for a reaction. What I mean by reaction is as simple as seeing, let's say this is the order book, right? Is literally as simple as seeing price, tap into it, slight candle here, pulling back up, retracing, literally something like that. It doesn't have to be like a big come down here, seeing it break, and you've got some breakout entry when now your risk to reward is 1-to-1. We still take risk, it's an aggressive entry, but that is the style of entry. When you've got the shift, you've got the liquidity, you've got the high time frame POI, taking risky, aggressive entries like that, even if it was to sweep the high, and you've still got the stop loss above the order block, that's still completely valid. There's no reason why price wouldn't just grab that extra sweep. There's a lot of things that can happen, but that's why you've got to be quite precise and strict on, where you're entering, right? So yeah, leave that there. So yeah, in terms of how I was looking for things in the morning, you've got to think like this is. Oh, that's actually quite late. I thought that was early in the morning. Oh yeah, it's because it was later on. So here, this would have been a valid London entry, right? And the whole point of this is because you can see price first tapped into the imbalance, right? First tap, that's a valid shift for me. That'd be a shift. So we're now looking at London Open, right? London Open, we've got the shift. Now what do we need? We need liquidity. First point of liquidity. That's our first point because there's no liquidity in this leg here. But this isn't going to be our first point of liquidity because there's no valid order blocks. This wick filled this order block. This wick filled this order block. So this is our first point. And then if you look at your supply, that's your supply. And the reaction could just be as simple as this. Seeing price push into it, right? Pulling back, pulled back up into that candle like I just said. Selling off. Could be anywhere here. Even if it was there. Doesn't matter if price pulls back. As long as it stays within the range, it's completely valid. Which is why you have your stop loss just above. Because as soon as it goes above and goes out of the supply, that's completely valid. One little tip as well. Let's say, for instance, this supply zone was this big. Even though price tapped into it here and showing some type of reaction, there's no reason why price won't come up for the additional sweep and just sweep the highs. Because we've got room above, we've still got room in this supply zone here just to sweep the high, taking a bit more liquidity from that high to then continue down. Completely valid. So if you're seeing things like that, even though we've shifted above and we're staying inside the supply, that's not a broker structure, it's just a sweep. So don't let that stop you from taking a trade. So yeah, that's my whole thing with mornings. So 8 o'clock we get a lot of volume. So between 7:30 and 8:30, is the main time I'm trading. Sometimes if we see an accumulation in London Open, then we may start to see some type of distribution later on into London, like 9 o'clock, 9:30, 10. When it gets close to 11:30, usually you don't get much volume, which is exactly a good example here. As you can see, 11:30, because we had the direction, price is going to go there, but you can see there's not a lot of volume. You can see all these little lower highs. High volume trades would be something like, for instance, that, because it was London Open. You can see huge impulse. Wherever your take profit would be, impulse, slight retracement, sweeping the liquidity from that high, second entry after the reaction, and so on and so on. I need a drink, Jesus. Has anyone got any questions regarding that example?
Okay, so you see those like highs that you said weren't liquidity. So zoom in. You know where your liquidity is?
Hold on. What was this one?
That one, yeah. Why would not the bottom, all those 3 lower highs, not be considered liquidity?
Well, they are. They're all liquidity.
Yeah.
But there's no point drawing a line on every single high because, like I said, none of these order blocks. There's no valid POI in here that's going to turn around. So make it cleaner. we just have the first one there because that is the only one that must get broken.
So you need it to be an order block to be liquidity. It can't just be a random high. If it's been mitigated,
Yeah,
then it's
no,
not liquidity.
any high. Well, all highs will have some type of order block looking candle, but it's got nothing to do with the candle shape and size. It's just a high, right? This high, that if there was liquidity here and price sweep this high and tapped into this supply zone, that would have been valid, but there is no liquidity. The whole point of the example is there's no liquidity in this one, so this is our first point. If there was, an order block, this order block was a bit higher, right? And it hadn't been tapped into, sweep of that liquidity, tapping into it up here, that then would have been valid. But because there's no room, nothing's valid in this section.
So it needs
Does
to
that
be
make
like
sense?
an unmitigated order block. Like it needs to be like unmitigated.
Yeah, everything has to be unmitigated.
Okay. Okay. Yeah, I guess that makes sense. It makes logic.
Luke, check
Anyone
the chat.
else? What do you think?
Check the chat. People asking questions. Nicholas.
2 seconds. Can you explain this again on the 11:30 trade? Didn't get it. Okay, so the 11:30 trade, it's all about the intention, right? So we figured our intention, which was see price react from this zone, see a shift, see a liquidity sweep, then we can catch the sell. So we've had our shift here. First point of liquidity is here. I'll just explain why that's our first point. 5-minute POI, which is this imbalance because the higher time frame POI, even if it's just 3-5 minute, completely more valuable than the 1 minute. I rarely trust the 1 minute unless it's inside of a 5-minute POI, right? Once we've got the POI, then obviously just the reaction, it's just the entry itself. We don't need to wait for the shift and stuff in the trade because we've waited on the higher time frame. So if this was all like a 1 minute short little cycle, then I probably would. But because this is the higher time frame, this whole zone is shifting. Like we're seeing the market flip. So the chances of it breaking above this is quite fucking slim because, as you can see, for price to continue up, I don't think there was an imbalance in here. This is the only point of interest. And for price to get down to this zone after failing to tap into it here, we'd have to grab liquidity. So that's our first point of liquidity. That's our first POI. So we've now got enough liquidity to push down into that order block. Does that make sense? Thanks. No worries. Is anyone else who's new to the Discord got any type of question? Is anyone confused? Is there anyone in here that's maybe used to retail style and kind of new into what's the word? Like if you're transgender, what do you do? Like you convert over to smart money concepts or liquidity inducement, that whole type of industry type thing. Anyone need any basic information regarding smart money concepts? Don't really like calling it smart money concepts anymore because it's not really smart money concepts. It's just the way to look at the market when it comes to entries and finding the intention. It's kind of not really. I've never really seen YouTubers that are trading smart money concepts teach the whole kind of concept around finding the narrative, finding the liquidity inducement and all of this stuff.
Yeah, barely anyone
Smart
calls
money
it SMC
concepts
anymore.
is literally just online. If you search smart money concepts, all it is just shift order block. They rarely actually teach you the tips behind liquidity, which is why the majority of people are shit.
Everyone just calls it RCT concepts now. No one refers to it as SMC.
No.
Alright then, Luke, is that everything you have to teach?
Can be for now. If anyone has got any questions during Tommy's explanation, then yeah, feel free.
Alright, I'll be doing exact same thing. I'll be explaining a couple trades that I took this week. Can you see my stream? It's good quality.
It's loading. Yeah, man, it's all good for me.
Alright, so I'll start off with how I wake up. I took a trade on Monday and Tuesday. I had one break even on Thursday, I think it was, but the only trades I actually took were Monday and Tuesday, and I gained 15.6% off both of them combined, and this is pretty much how I do it. So obviously hop on for 7 a.m. Frankfurt Open, and to find my daily bias is so simple. I don't understand why people don't utilise it as much, but pretty much all you have to do to find your daily bias for London Session or London Open or whatever you're trading, simply I go on the 1 hour and see the most recent breaker structure, and before so this is Frankfurt Open here. I'm looking at this move here. That is literally where I'm looking for my trade, and obviously below 50% is most optimal, but that's for the external moves. For the internal moves, it doesn't make a difference, considering I'm only holding the trade for maybe just London Session. If I know this reacted to a point of interest below the 50%, I will be holding that for an external position throughout the day, for maybe for max 3 hours. But so obviously, as you can see here, had this order block here, break structure instantly, broke this structure here as well. So I just knew it was going to be bullish for the short term, well, for London Session at least. So knowing that it's going to be bullish, I use my 15-minute for my for all my point of interest after finding daily bias, because obviously this is intraday trade and you don't need any 4-hour order blocks unless it's refined and stuff like that. But first point, we're looking for liquidity, and obviously our first point of liquidity is this low right here, and this low has mitigated this order block, so we know that that's not a valid 15-minute point of interest at all. And the first point of interest beneath that is this 15-minute imbalance here. So we'll drop down. So having this with our point of interest, obviously we have 15-minute point of interest underneath, which I did have marked up as well, just in case it didn't react to this. But I like to use the quarterly theory as well to understand the lower time frame a lot better, which I won't go into full detail on. I'll leave that more for students and people with the course, but I'll briefly go through what I've seen here. So the quarterly theory is 90-minute cycles, which people say pretty much control the market and explain why the market does what it does. So it's all based on the true open of the day, which is always going to be New York time, and essentially the whole rule is AMDX. AMDX refers to every single quarter, and the first quarter, A, is accumulation, which pretty much is just a build up of liquidity like this here, and that needs to be swept in our next quarter, which is manipulation in Q2, which will obviously take out the low or take out the high of the liquidity. Quarter 3 is going to be distribution, which is just a continuation, or where you can take the trade, as in, like, I didn't take this trade here, but you could have got in somewhere around here to continue up. And then the last quarter is X, which stands for continuation or reversal. But there's a bit of a complication when it comes to the whole quarterly theory, which is quarter one decides what the whole rest of the quarters will do. For example, if quarter one looks like this, and it's like actually like building up, and it's breaking structure and stuff like that, we know that the next quarter, which is Q2, will have to build up liquidity before Q3 manipulates it to continue on. So essentially, instead of it being A M D, we'll leave out the X for now. Instead of it being A and D, if we know that the first quarter is continuation and actually breaking structure, then it becomes X A M D. So for this example right here, it's obviously it is breaking structure, but it's ranging more than breaking structure, so we know that it's accumulating, and that accumulation is taken out in the next quarter. which then we see, I work on 1 minute by the way, as you can see. We see a market structure shift right here, which I'm then looking for a 5-minute order block to enter off of. And for this example, it's obviously this one right here. That's our 5-minute order block, but I like to refine it on the 1 minute. I don't think Luke does that as much, but on the 1 minute, oh shit, wrong order block. Order block's down here. So on the 1 minute, the way I look at it is, within this 1 minute order block, we have a fair value gap here. That needs to be filled. However, because it's been partially filled here, that is not where I'm looking for my entry. And I don't have the seconds, but I'll explain why it could be useful. So this section here, as you can see, it's not big wicks, it's nothing major, but essentially what these wicks represent, if you went down to the 15-second time frame or any seconds time frame, this would be a low.
Micro range.
Yeah, this is micro range that essentially acts as a low that will block this 5-minute order block. So if we have to react to this 5-minute order block and there's a block in the way, we know that we have to enter from underneath it. So that is my point of interest of where I'm looking to execute my trade. And my trades will always have anywhere between a 2.5 to 5 pip stop loss, but literally 90% of the time it's a 2.5 stop loss. So for this example, 2.5 there, all I do is I wait for some sort of reaction on my in my execution zone, because I know that if it doesn't react directly under this, it will continue to drop down. If it carried on coming down here and reacted here, I would still enter there, but I know the only reaction would come underneath here. GBP USD, which is what I trade obviously, only pair I trade. Luke trades Euro USD, AUD USD, all that stuff. I don't at all, but GBP USD works a lot more cleanly when it comes to entries. Like Luke was saying about the other pairs, it could sweep this low and stuff like that. I never see that happen on GU whatsoever. If I've got the what the fuck's it called? If I've got like the 1 minute point of interest right, as in if I've, what is the word? Luke, help me out.
What's the word?
I don't know. My mind's gone blank.
Okay,
Hello?
what was you explaining?
5-minute order block, but I've chosen this bit.
I
Pinpointed.
see. I don't know.
Oh, don't worry. But anyway, if I've I don't know. If I've gone to this 5-minute order block,
Refined.
yes, refined. Thank you. I don't know how I forgot that.
All right, mate.
Thank you.
What an obvious fucking answer.
Oh, I know. It's just made my mind gone blank. If I've refined it correctly and I've got my execution zone right here, I know for a fact that it reacts past here. But on EU, it could sweep it. Yes. Obviously, within this 5-minute order block here, if you're just looking at this 5-minute order block here, and it starts pulling up and shit here, obviously it will sweep that because it needs to go down here. So maybe Luke doesn't refine it or whatever. So on G you just won't sweep it. But I enter a 2.5 pip stop loss, and I'm targeting a order block up here. And like I was just explaining here about the seconds liquidity, this is 1 minute liquidity, but obviously in the seconds it'd be a proper high, and this high is blocking this order block here. So that's where my TP would be, considering this 15-minute point of interest was not below the 50% retracement of this move here. So I knew it wouldn't be an external move. So I knew that this short-term buy is just internal, it's not an external move whatsoever. What's being asked? How do you know if it has to react below that candle again? Because this candle here, if you had the seconds time frame, it would be more helpful, but I've just learned to see it on here. Right.
What's
here,
the date and time? I've got the seconds on my laptop.
7:38 AM at Monday 20th November. So I know within this the top of this 5-minute order block is literally where my break is here, so I don't need to put the whole zone around it. But within this 5-minute order block, this would be our first point of interest to enter under after it built up liquidity. However, you can see while building up liquidity, it's already entered that, already partially filled this imbalance here. So I know that that's no good. The next 1 minute point of interest for me is technically this imbalance, but I look at it differently because obviously there won't always be this imbalance here, but I look at it completely differently. This candle, these wicks on every single 1 minute candle represents a high or a low in the seconds time frame, and that high or the low will be blocking the 5 minute candle which we want to take our move on, and we know that if it's blocking it, we need to enter beneath, or obviously if it's a sell, then we're looking to enter above the liquidity within that 1 minute order block. So obviously this low, this second's low, literally the only place we're looking for our entry, and if it didn't retrace there, then who cares, it is what it is. Just like on Friday, where is it? Just like on Friday here, I didn't manage to get my entry because I was looking to get in right underneath this low, but would have been lovely, but it is what it is. And obviously, as usual, we have our proof right here. 5-1 entry, 5-2 is when my stop loss was, just above my entry. Very nice trade.
There's not actually anything there. It is an imbalance though on the lower time frame.
Fair play, but still, it's still point of interest for low time frame. But yeah, that's my entry for Monday. Made me a very nice percentage. Then on Tuesday, I did the exact same thing. I can explain the.
Did you answer Lamar?
What did Lamar ask? If we took the trade on that bullish candle, would we be wrong on the 1 minute? What?
Yeah, the trade you just had looked like it changed character, so like that's how I was looking at it.
Oh, we're talking about taking it to the downside.
Big like bullish candle right there.
I don't wait. Which one? Which one are you talking about? Bullish
The
candle.
one you got the line that right above the second you were talking about.
Yeah, right here.
Yeah, that whole candle right there, like you
Yeah.
guys were saying, like changed the character and took it right there, you know.
Well, you could have if you're that risky.
We hadn't had the shift yet.
Yeah, you could have if you're risky, because technically, if this was going to be our high that we need to see changed, this does fill up enough room of it that you can assume that it would continue going up. But that's just not how we trade, because obviously we want to keep our risk small, wins big, you know.
Thank you.
No worries. Then the next trade I'll be brief on. I won't explain the quarterly theory on that because I'll save that for the students. But exact same thing. 7 AM open. The most recent break for me is from here to here. That's all we're looking for. This is our range that we're looking to trade in. If we want external moves, we're looking for point of interest beneath the 0.5. If we're looking for internal moves, we're looking for anything above that. And obviously, if we're looking for trades within here, our next point of interest would be next area of liquidity, which for me was, I'm not going to bother going down to it, but this is a half an hour high. So that was enough liquidity for me to target for the time being for a internal move. So knowing that's bullish, 7 AM hopping on within this range, looking for liquidity. Nice liquidity there, built up more liquidity, even more liquidity. Absolute perfect RFC candle. We know it needs to be filled, so that's our first point of interest. A lot of people, well, I know quite a few people would count this as your whole 15-minute point of interest, which it technically is, but because there's a candle with big wicks, RFC candle, we know that has to be specifically filled. So with this being my point of interest, then we have the liquidity, we have the direction. Knowing that it's internal, obviously we're just targeting some sort of liquidity. Dropping down to the 1 minute, we see it enter our point of interest. We see our change of character right here, or market structure shift, whatever you want to call it. That's enough for me, because I know, even if that's wrong, because I know Luke would count that, or some people count that, or some people use 5 minute highs and stuff like that for breaks. But I know even if I got the market structure shift wrong,
yeah, that'd be the same for me.
I know, but a lot of people use different time frames for it. But I know that if this shift is wrong, as in like a 5 minute shift is correct, but the 1 minute is wrong, then I would know, because I'd see the liquidity building up, or it just wouldn't be acting right before entering my point of interest. So it's very easy to tell once you know internal structure. but we're looking for liquidity to build up, which is happening right here. I only have my one point of interest. I always go for my optimal trade entry, the only place I want to enter. I don't have any other places I want to enter, because otherwise then I'll be looking for that every time, and then it'd probably end up with some losses. But with this point of interest and this liquidity built up, I thought it was completely perfect. Checking on it, it reacted to a 3-minute imbalance, I think. No, maybe it just reacted to the order block. Yeah, it must have. Yeah.
I'm just quickly going to say one tip as well, which a lot of people get confused. When it comes to waiting for reactions with internal, external, right? See that Tommy's example there, that trade there, right?
Yeah.
When it's the start of an external leg, it's a lot harder to get it mixed up with, you know, the breaker structure being a liquidity sweep. Because if it's, I need to screen share to really explain it. I'm going to quickly share my screen quickly.
Go for it.
When it's an internal, it's harder to see which one's going to be, you know, if it's a liquidity sweep or a breaker structure, right? But because his example is an external, so external means when he's buying here, it's, you know, he's looking for the continuation, right, to the upside. If it was an internal, it's because he's obviously, I don't know, let's say internal is, you know, it's a continuation, so it's going to be here, right? The whole thing with internal, external, what I'm trying to say is people are seeing that as a breaker structure or a liquidity sweep. When it's the external, when you're in this zone, seeing it break, let me try to draw it. If we're seeing it break here, majority of the time that is going to be a break, because we know that this is going to be the external leg. So we know that if price comes down here, it's because the whole direction is trying to change. So it's a lot easier to get mixed up with a liquidity sweep and a breaker structure, because if this was internal, right, and we knew that we thought price was going to come to this supply and then sell down, people seeing this as a breaker structure, that could just be the liquidity sweep it needs. So I am not going to lie, I'm forgetting the whole point of what I'm saying, but I've actually lost my head. I've actually lost my head. What was I saying?
Just focus
Luke's
on
a
higher time frame.
scammer.
Yeah, so mixing up a breaker structure can be very easily done depending on the different stages. So if it's internal, then the majority of the time you're seeing these breaker structures, without me explaining, you know, this is all mentorship shit, I don't know how I'm explaining it, it's most probably a liquidity sweep on internal. But because it's external, we know that it's going to continue the trend and that the low is going to be respected, because if it breaks that low, then the whole direction is changing, right? So when you see a shift on just before the external leg, it is going to be a breaker structure, not a liquidity sweep. So what I'm trying to say is when you're trading internal and you're seeing, for instance, that breaker structure, if that was internal, that would have been a liquidity sweep and he would have been selling there instead of buying. Because the roles are different, it's a break, not a sweep. It's hard to explain, I don't really know.
All he's trying to say is don't get confused with lower time frames. Stick to your higher time frame narrative, stick to your zones, and only look at lower time frame when you're in those zones.
Yeah, basically. Join a mentorship. Fucking hell.
Yeah, so Tuesday's trade, straight to 30-minute high, execution, exact same as what I plotted here. Perfect, lovely, boom. Back to this one that I missed. I was looking for that entry, didn't hit. Was taking it to this high here. Could have taken it to the high of the news, but I don't like doing that because news scares me. News is scary. Don't trade news unless you have no slippage. If you have no slippage, then go for it. But could have taken it to this high. Could have been a very, very nice, almost 14%. Yeah,